Well, I think really the consumer spending data we're going to see for the month of June from an economic perspective is going to be really important. Our best guess is that the consumer is going through a soft patch right now. We have already clearly seen that in the retail sales data. Within consumer spending, we're going to get more information on services. We heard last week from some of the service-oriented consumer companies, airlines, hotels, restaurants, that consumer spending in the service sector also is a little squishy. It's not just goods, it's also the service side. So consumer spending, how weak will it be as we go into the third quarter, excuse me. We are expecting a soft patch. We think it will be on the softer side, but reflecting in part demand was pulled forward in anticipation of these tariffs. And you have already seen price increases, and that's also impacting consumer spending.
How do you make sense of that, given what we heard from airlines over the last couple of weeks? Not every airline, of course, but I'm talking mainly of United and Delta, who said, as we got a little clarity about what was happening with tariffs late June, early July, we started to see a real big turnaround when it came to consumer spending. How do you gel those two things?
I think it really is a bifurcated consumer. One of these days, I look forward to not using that word anymore. We've talked about that for a couple of years now, but there is really a bifurcation. The higher end business-oriented airlines are, I'm not an airline analyst, but they are being supported by the higher end and businesses, whereas the airlines that reported last week, a couple of them anyway, and again today, some layoffs, those are more for the lower end consumer. And the lower end consumer is really getting squeezed from these tariffs. It is basically a regressive tax on the consumer. So the bifurcation, companies that are geared toward businesses and the higher end consumer can plow through this. Those that are more tied to the lower end consumer are struggling. The consumer really is looking at price points right now.
I want to get to what our Sean Donnan wrote about on the Bloomberg today and at Bloomberg.com. And that has to do, Nancy, with the damage to the global economy from American protectionism. He notes that it's becoming increasingly evident, even if financial markets get somewhat excited as we see trade deals being done. He says it all amounts to another step change in the trade barrier that the president has erected around America, which is starting to reshape trade and investment patterns worldwide. Not his opinion, but his reporting out that Sean has done here at Bloomberg. And Bloomberg Economics saying the hit to the world economy will reach $2 trillion by the end of 2027 relative to its pre-trade war path. It's going to be a different global environment, yes?
Oh, for sure, it's going to be a different global environment. But I think we have to look at the economy as three-dimensional chess, not just as a flat board. No question, tariffs are a tax. I'm definitely more for free trade, but I'm also for fair trade. Maybe we can shake one little positive out of this and get some fair trade, i.e. incrementally sell more to Japan and Europe in particular. But to be sure, right now our effective tariff rate that we're calculating is about 17. Now it's down dramatically, but 17 is the highest since the 1930s. And so to be sure, that is a headwind to global growth. But I think that is just one part of the puzzle. The second thing that's going on in the United States is the capital spending cycle. And the tax legislation, or that was just passed actually in the One Big Beautiful Bill, indeed does very, very, very significant accelerated depreciation for capital spending, full CapEx depreciation for 80% of CapEx. That is going to be a significant boost to cash flow, corporate cash flow. We've already heard that. Last week we had 4 companies, AT&T, Verizon, T-Mobile, and United Rental, all say this tax legislation is a support for their cash flow. So again, I think we can't just look at one level. We have to look at what's going to happen to capital spending. And capital spending, I call it the ugly duckling of economic data. It's underappreciated for what it does for growth. It creates productivity, profitability, and lifts potential GDP growth, and that eventually lifts living standards. So quite frankly, I think that article is a little bit way too one-sided, and you need to look at the bigger picture. And near term, again, this economic soft patch for sure, but you're already seeing signs, the companies that I mentioned, you're seeing it in data where U.S. capital spending is picking up, and that's going to come back and help not only productivity, but the job cycle as we go through 2026. So it's important to look at the bigger picture, and I didn't mention deregulation. I'll stop, but that's also another really important support for the U.S. and therefore the global economy.
But is it, okay, and one of the things I want to go back to is you say support for the labor market. We had Rob Kaplan on, former president of the Dallas Fed, on Friday, and he said, he talked repeatedly over the tight labor market and the impact of immigration perhaps on that and how that could then impact U.S. growth. So I just want to throw that out there. But when you talk about CapEx and what it can do for growth, certainly great for company balance sheets, does it help workers? Does it actually provide momentum throughout the economy?
Absolutely. Again, it's called a business cycle for a reason. And when businesses invest, again, they improve their profitability through productivity. And if companies are making more money, if their cash flow is indeed going up, that is incentive to spend, not only on capital spending, but eventually on jobs and in wages. And you see it historically in the data. Again, capital spending always grows faster than housing. Capital spending, except potentially in recession. Capital spending always grows faster than consumer spending. And so it's really, really underappreciated. Businesses create jobs and pay wages. So near term, absolutely, I would argue we're in a soft patch. The unemployment rate is grinding higher. Although initial claims have come down a little bit, continuing claims remain elevated. Companies, I'm not sure the labor market is tight. Continuing claims remain very elevated. Companies are reluctant to hire given the trade uncertainty. We think as we go into 2026, the improvement in corporate profits, which right now are sluggish, but they'll improve into 2026, then leads to a stronger labor market. So yes, there's nothing more beneficial for the consumer than stronger productivity growth, a low inflationary environment, and that gives you stronger real income growth.
To what extent is that productivity growth, in your view, hampered or not by tariffs?
I don't think it really is hampered by tariffs per se. Incrementally, maybe from a higher cost of certain investments. As a result, we are seeing an increase in the price of certain capital goods. So at the margin, that is a little bit of a nick. But this is a very significant full capex depreciation, which again, those four companies early on in this earnings season. I can't wait to hear what happens over the next couple of weeks. That I have seen significant savings in cash flow. So we don't know yet the full quote unquote saving to companies from this new depreciation schedule, and it could more than offset anything, which I think it does, from a tariff perspective. So tariffs are a one-time tax versus capital spending has a very long tail. And will help the economy at least through 26, if not into 27.
So, Nancy, we've got a Fed meeting, as you well know, Fed decision on Wednesday. So you say we're in a bit of a soft patch right now, but you're looking for improvement in 2026, and you see profits leading to a stronger labor market. If we've already got stimulus coming as a result of some of the tax measures by the president's big, beautiful bill, then does the Fed should they not do anything for maybe the rest of the year because they don't need to? There's stimulus already coming, and they've got to be careful about inflation. Just got about 40 seconds.
Yes, I would agree that the Fed doesn't need to cut rates. Our guess is they probably do, according to my colleague Benson, at least once, but we don't really need more than that. They already cut rates 100 basis points last fall, and that's still working its way through into the economy. So good point. Combination of the incremental, I don't want to call it fiscal stimulus. It's basically an implicit tax cut for corporations and deregulation are not inflationary. They're actually disinflationary through improving productivity growth. But net, no, we really don't need it, but we'll probably get at least one.